In the space of a single long weekend, silver did something that most market veterans swear they have seen only a few times in their entire careers. $67 per ounce, $45. That is roughly a 35% swing in less than 4 days, a move so violent it belongs in the category of events that change how risk managers sleep. Not months, not weeks, in 96 hours. And the unnerving part is that the move didn't simply happen on a chart. It happened while the real-world market underneath the chart was sending signals that did not match the headline narrative. They said a move like that could not happen without a breakdown. And in a sense, it didn't happen without one, just not the kind most people were looking for. Because while the screen price was collapsing, the physical market was telling a more complicated story. Dealers described being overwhelmed by the metal flows that came in after the spike. Refiners were described as backed up. In some reports, refiners stopped taking new silver because capacity was saturated. It suggests a system that was stressed in more than one direction at the same time. Here's where it gets interesting. When a price chart looks like a cliff, most narratives become lazy. People reach for one explanation and repeat it until the next candle prints. But the data shows something else entirely. Paper and physical can move in opposite directions for a while, and that divergence is often the first signal that the structure underneath a commodity is being tested. Institutions already know this. They don't just watch price. They watch delivery terms, inventory categories, financing conditions, and the subtle frictions that appear before the public even notices a story is forming. Welcome to Roki Studio Markets, where we translate the vault numbers, the warehouse classifications, and the real-world constraints into a story that the headline chart can't tell. If you're here for calm, data-first analysis in moments when the market tries to bait everyone into emotion, consider staying with the channel the way you'd keep a wise elder nearby. Not for hype, but for clarity. And drop a comment with where you're listening from, because in a market like silver, geography is not a detail. It's often the difference between what the price says and what the market can actually deliver. Now let's reconstruct what happened and why it matters. Silver entered late January with momentum that had been building for months. The prior year had already been extraordinary, with silver rising more than 130% over 2025 by some widely cited tallies. That kind of move changes behavior. It pulls in momentum traders, it forces hedgers to adjust, it attracts speculative leverage, and it turns every dip into a buy the dip story until the market decides the dip is not a dip. 67, and the psychology shifted from confidence to crowding. 45 by February 2nd. In normal conditions, a collapse like that tends to cool physical demand immediately. The logic is intuitive. Sellers rush in, trying to get out before it gets worse. Dealers widen spreads because risk is high, but the pipeline usually stays functional. Yet the reports circulating in the wake of the spike and drop described something far messier. Some coin shops were described as swimming in silver, not because demand vanished, but because a wave of selling arrived all at once. At the same time, refiners were described as clogged, struggling to process the flood into the kinds of standardized forms that larger buyers and distribution channels depend on. That is how you can see too much metal and not enough product in the same week. That mismatch is the central mystery. If the paper price is collapsing, why would any physical channel feel tight? The answer is that physical tightness is not only about total ounces in existence. It is about immediacy, specification, and the ability to mobilize metal at the margin. A market can be well supplied in total and still experience shortage dynamics in specific products and time windows. A refinery bottleneck can create scarcity in new bars even while old bars are being sold. A logistics bottleneck can keep premiums elevated even if a spot quote is falling. And a rush of public selling can jam local channels without solving the needs of buyers who require different products, different purity, or different sizes. One major bank research view framed 2026 as a structurally higher price environment with an average price expectation around $81 per ounce, even after acknowledging how sharp volatility can be at higher levels. That matters because it signals that professionals were considering a new regime, not a quick return to an old one. An $81 average is not a promise of calm. It is an admission that the center of gravity may have shifted, and that the market swings could be occurring around a higher plateau than people were used to. To make sense of the present, you have to see the pattern, because silver is famous for repeating its own lessons with different costumes. Start with 1980. Silver surged into January of that year and then collapsed, leaving behind a case study in how concentration, leverage, and policy responses can collide. Then look at 2011. Silver surged into April, reached close to $50 per ounce, and then experienced a rapid series of risk-tightening measures in futures markets that coincided with a violent sell-off. In both cases, the public saw the move as sudden. But inside the system, the stress built and then snapped, often through the mechanics of leverage and participation terms, rather than through a simple change in physical supply overnight. Now look at 2026, an explosive high followed by an explosive drop, while the physical ecosystem shows signs of friction. The recurring pattern is not mystical, it is structural. Silver is traded as both a financial instrument and a physical commodity. The paper layer can expand exposure far beyond immediate physical availability because contracts are standardized, margin is a fraction of notional value, and liquidity can be created by willingness to take the other side. The physical layer cannot expand itself at the same speed because metal must be refined, fabricated, assayed, transported, and custodied. When those two layers get out of sync, the market can discover a paper price that is temporarily disconnected from the real cost and time required to secure physical metal in the form and location that matter. So who are the players in this argument? Start with the exchanges and clearinghouses that define contract terms and manage settlement. In the futures world, trading volume concentrates into standardized contracts that allow participants to gain exposure without paying full value upfront. That leverage is not inherently evil, it's a tool. But when volatility rises, the tool cuts both ways. Clearinghouses and brokers protect themselves in the system by adjusting margin requirements, increasing risk buffers, and tightening credit. Those changes are often framed as technical, but their effects are deeply human. They can force participants to reduce exposure quickly, even if those participants believe the underlying asset is valuable. Then there are the banks and trading houses that provide liquidity, financing, and inventory management. They are not monolithic, and they don't all take the same side. Some hedge industrial clients. Some trade for their own books. Some facilitate flows between regions. What they share is a sensitivity to the cost of capital and the cost of risk. When volatility spikes, capital becomes more expensive, and positions that looked manageable in calm conditions can become untenable under new margin terms. Liquidity can vanish, not because everyone suddenly changed their mind, but because the balance sheet cost of holding risk rises sharply. On the physical side, the actors are equally important. Refiners are the quiet heartbeat of the system. They take scrap doré and other sources and turn them into bars and products that meet specific standards. That takes time, capacity, and quality control. If refiners are backlogged, the system cannot quickly convert retail selling into wholesale deliverable forms. Vault operators hold metal under custody rules that may restrict what can be moved quickly. Large owners of metal may have little incentive to sell into a chaotic market, especially if they value optionality more than a few extra dollars in spot price. And retail dealers live in the world of spreads, shipping times, and the psychology of buyers and sellers walking through the door. This is where inventory data becomes the bridge between paper and physical, and it's also where many misunderstandings begin. One of the most watched indicators is London Vault holdings under widely referenced reporting frameworks, 3% from the prior month. Those are massive numbers, and they are real metal in custody, but totals do not automatically translate into availability. Another closely watched set of figures comes from exchange warehouse systems, where categories like registered are often interpreted as metal available for delivery against futures contracts. 26 million ounces. Again, this sounds enormous, and in absolute terms it is, but categories matter. Metal can exist within the system without being offered for delivery. Metal can be reclassified. Metal can be eligible, but not registered. Metal can be owned by parties who are not motivated to part with it at the posted price. And in moments when volatility is extreme, the market learns quickly that inventory and deliverable inventory are not the same thing. Now we can state the dislocation clearly. The paper market was signaling a brutal collapse, consistent with forced liquidation and a sharp risk repricing. The physical ecosystem was signaling constraints and delays, consistent with a system that could not instantly translate flows into deliverable forms. Add in the dealer reports of being overwhelmed and the refiner backlogs, and you get a market that is simultaneously flooded and tight, depending on where you stand. That is not a paradox once you accept that silver is not a single market. It is a network of markets connected by conversion steps, custody steps, and time. Think of it like a city in a sudden storm. The reservoir might hold plenty of water, but if pumps fail and roads flood, some neighborhoods still have empty taps. In the same way, there can be a lot of silver in aggregate and yet a shortage of immediately deliverable, correctly fabricated product in the places where buyers need it. Premiums are the system's way of pricing that friction. When spot collapses but premiums stay elevated, the market is saying, quietly, that the screen price is not the full cost of access. Let's anchor this in the evidence. 45 by February's text, a swift drawdown on the order of 35%. 3% month over month. 26 million ounces in early February by widely tracked warehouse summaries. Fourth, the institutional frame. An average price expectation around $81 per ounce for 2026. Built on the context that silver had already risen more than 130% during 2025. Those numbers do not tell a single neat story. They tell a story of a market whose surface is moving faster than its foundation. Now we ask what this implies, not as a prediction, but as a forward interpretation of a known pattern. When paper and physical diverge like this, one of two reconciliations usually follows. In one path, liquidation and higher financing costs continue long enough that physical tightness eases. Metal flows from weak hands to strong hands, refiners clear backlogs, premiums fall, and the screen. Price and real-world cost converge. In the other path, physical constraints persist or intensify, and the paper market is forced to respect the reality that immediate delivery has a different price than theoretical exposure. In that path, the cheap screen price can coexist with stubborn real-world pricing until the paper layer is compelled to reprice access. The mechanism that drives these reconciliations is the interaction of leverage and logistics. On the leverage side, futures exposure is financed through margin. A participant can control large notional value with relatively small posted capital. When the market moves rapidly, margin calls arrive quickly. Some participants meet them, others reduce exposure. When many reduce exposure at once, selling becomes mechanical. It is not always about belief. It is about cash. That is why the steepest drops often feel like the market is falling down stairs rather than walking down a slope. The selling is not discretionary. It is enforced by the structure. On the logistics side, physical silver cannot respond at the speed of a margin call. Refining takes time. Assaying takes time. Fabrication takes time. Shipping takes time. Vault withdrawals and deposits involve paperwork, security, and scheduling. If refiners are backlogged, it means the system's capacity to transform supply into the right form is constrained. That can keep physical premiums elevated even when the screen price is falling, because immediate product is still scarce. In those moments, the market is not arguing about whether silver exists. It is arguing about whether silver can show up in the right form, at the right place, in the right time window. A simple analogy makes it intuitive. Imagine event tickets. On an online exchange, prices can crash in minutes if many sellers panic at once. But outside the venue, people still pay a premium for a ticket right now because the show starts soon and the gate is the constraint. The online price reflects sentiment and liquidity. The sidewalk price reflects immediacy and access. Silver, under stress, behaves like that. Spot reflects the most liquid marginal trade. Premiums reflect the bottlenecks between desire and delivery. So what can be watched as this story continues? Not instructions, just indicators that reveal which reconciliation path the system is drifting toward. One indicator is the relationship between spot and widely quoted retail premiums, because premiums compress when logistics normalize. Another is the pace at which refiner backlogs clear, because that determines how quickly metal sold into the system becomes new standardized product. Another is the direction of reported vault holdings over multiple months, because persistent draws can indicate sustained demand for custody and mobilization. Another is the composition of warehouse categories, because shifts in what is registered versus eligible can signal changes in willingness to deliver. And another is volatility itself, because when volatility remains high, it keeps financing costs elevated and keeps the leverage mechanism active. From these indicators, 3 broad scenarios are historically common. In a conservative scenario, volatility subsides, leverage is cleansed, processing catches up, and premiums normalize as the paper and physical markets converge. In a moderate scenario, the market finds a higher equilibrium range with periodic spikes and pullbacks, reflecting a new balance between investment demand and industrial sensitivity at higher prices. In a more aggressive scenario, the physical constraints persist, while confidence in paper liquidity remains fragile, and the market experiences episodes where the screen price moves sharply, but the real-world cost of immediate product resists, forcing a more dramatic realignment. None of these are guarantees. They are simply the shapes that reconciliation tends to take when the structure is under stress. This is where the quiet divide forms. Some people watch silver as a chart and feel whiplash, because every candle becomes a story about emotion. Others watch silver as a system and feel less surprised because the system has been signaling stress through bottlenecks, inventory classifications, and the persistent fact that real metal moves slower than financial claims. It is not about being smarter. It is about paying attention to the right layer. Information is not evenly distributed, and in markets, that unevenness becomes visible when volatility forces decisions. Institutions tend to move first because they monitor structure. The public tends to react last because it watches price. So if the last few days felt like a shock, let the shock become a map. A 35% move in less than 4 days is not normal. It is a signal of stress and leverage. Dealer and refiner bottlenecks in the same window are not random. They are signals of friction and constraint. Large reported vault totals alongside tightness at the margin are not contradictory. And institutional framing of a higher price regime alongside wild swings is not hypocrisy. It is the acknowledgement that a market can be structurally tighter and still behave violently when leverage and participation terms collide. This is Roki Studio Markets, where we decode what matters before it becomes headlines. If the connections we just traced made the chaos feel more structured, Keep that lens close, because the market rarely resolves a dislocation quietly. The question isn't whether silver can move. It already did. The question is whether the structure beneath the move is tightening or loosening as the market tries to turn two realities into one price. One more layer makes this even clearer. Silver is not consumed and accumulated in the same places. Industrial demand is global, and large flows often move toward manufacturing hubs where silver is used in electronics, solar components, chemical processes, and specialized alloys. Investment demand, meanwhile, can surge in regions where distrust in currencies rises or where cultural saving habits favor precious metals. When those flows collide with transport, assay, and customs realities, the price on a futures screen can be telling the truth about liquidity while missing the truth about access. That regional dimension is also why East versus West is more than a slogan. A buyer seeking large bars for industrial use cares about continuous supply and reliable fabrication, not about a single day's spot print. A Western retail buyer might care about a 1-ounce coin today, with a premium that reflects mint availability, dealer inventory, and shipping time. These are different products connected by the same underlying metal, and in stressful periods, they can behave like cousins rather than twins. It is also worth remembering how quickly the paper market can manufacture intensity. A futures contract can be bought or sold in milliseconds. A leveraged position can be opened with a fraction of the notional value. When volatility spikes, the rules of participation can change overnight through higher margin, lower credit, or tighter internal risk limits. That is the execution layer most people never see. Not a secret meeting, but a cascade of mechanical constraints that force behavior regardless of belief. We have seen echoes of this in the modern era as well. In early 2020, markets across assets experienced rapid deleveraging, and liquidity became the dominant factor, even when fundamentals argued for stability. In early 2021, silver briefly became a focus of retail attention, and the discourse revealed how few people understood the difference between trading a symbol and sourcing a bar. Those episodes did not mirror 1980 or 2011 perfectly, but they rhyme in one crucial way. When attention and leverage rise together, the system's plumbing becomes the story. So when premiums rise again while the headlines talk about falling spot, that is not a trivial curiosity. It is the market admitting that price discovery is fragmented. It is the market revealing that the real price depends on form, timing, and access. And it is why the calm approach is to watch the reconciliation process rather than the daily drama. When that fragmentation narrows, the move is usually swift, and the late arrivals wonder why it felt so sudden.